Welcome to the Deep Dive. Today, we're jumping straight into Coca-Cola's Q3 2025 numbers. Earnings, guidance, the whole picture.
Exactly. We're going to unpack what's really going on behind those results, look at their strategy, consumer trends, basically figure out what it all means.
Okay, let's get right to it. The headlines look good, definitely beat analyst expectations. Net revenue's up 5%, that's $12.5 billion.
And organic revenues, maybe even more telling, up 6%.
Right. And the bottom line, comparable EPS that grew 6% too, came in at 7.82 cents when I think the street was looking for, what, 78 cents?
Yeah, 78 cents was the consensus, so a solid beat there. But what really jumped out, I think, was the operating income.
Oh yeah, the reported number was huge, up 59%.
Which is, partly due to some one-offs. But even the comparable currency neutral number, up 15%, that's strong.
15%. That really shows some operational strength, doesn't it? Getting more from their investments.
It does. It suggests real discipline. Now, the CEO, James Quincey, he did mention the environment's still challenging. No surprise there.
We hear that everywhere. But he also sounded pretty confident, confirmed they're on track for the full year 2025 guidance.
And that confirmation matters. They didn't touch the outlook. Still expecting 5% to 6% organic revenue growth for the year.
And about 8% comparable currency-neutral EPS growth. Holding steady.
Holding steady. But we absolutely have to talk about the currency impact. It's a big factor.
The strong dollar hitting those international earnings when they bring them back home, right?
Precisely. It wasn't small either. In Q3, it was a 6% headwind on that comparable EPS number.
6%. Wow. So the underlying performance ex-currency was even better.
Much better. It shows they're managing what they can control internally quite well, even with that external pressure.
Okay, so here's the interesting part for me. Organic revenue up 6%, great. But then you look at global unit case volume. The actual amount of stuff they sold, only up 1%, and flat in North America, flat in Latin America, big markets.
Right.
So if you, the listener, aren't drinking significantly more Coke products, where's that 6% revenue growth coming from?
That's the price mix story. That grew by 6%. That's your answer.
Okay, break that down. Price mix 6%.
Yeah, so roughly 4 points of that is just pure pricing. Keeping pace with inflation, more or less.
Right.
But the other 2 points, and this is where the strategy really shows, that's favorable mix. Product mix, package mix, premiumization.
Premiumization. Okay, what does that look like in practice?
Yeah.
Are we talking smaller cans for more money per ounce, or pushing the fancier brands?
It's really both. And it reflects a split they're seeing in consumers. Management talked about this divergence. Your higher income consumers, still spending. They're buying the premium stuff. Fairlife milk, Topo Chico, sparkling water, Smart Water, Core Power protein shakes.
And buying them in more expensive places too, right? Like these restaurants, airports.
Exactly. Premium channels, higher margins for Coke, fast casual, amusement parks, you name it. That's driving that positive mix.
But what about everyone else? I mean, there's a lot of pressure on lower-income households globally.
No, they see that clearly. They talked about value-seeking behavior from that group. They're not ignoring them.
So what's the plan there? Just hope they keep buying?
Not at all. It's about targeted affordability. The CFO specifically mentioned things like the mini 7.5-ounce cans.
The tiny ones.
Yeah, often priced under $2 in a convenience store in the U.S. It keeps those consumers in the Coke ecosystem, even if, yes, the price per ounce is higher. It's a way to keep them engaged without deep discounting.
That's a fine line, though, isn't it? Pushing your most price-sensitive customers to the highest cost per ounce format. What if a cheaper store brand comes along?
That's always the risk, the competitive threat. Coke bets on its brand power. Plus, they use what they call revenue growth management, RGM. It's sophisticated stuff.
More than just price hikes.
Oh, yeah. It's about optimizing package sizes, pricing tiers across different stores, different neighborhoods, timing promotions, the whole 9 yards. They want a Coke product available at every price point, but ideally one that works best for their bottom line.
Makes sense. Okay, shifting gears to the actual drinks. The health trend isn't slowing down. Trademark Coke, the original red can, only grew 1% globally.
Yeah, pretty sluggish. But look at Coke Zero Sugar.
Well, no, up 14% across all segments.
14%. That's huge. And they're quite open about it, that demand for zero-calorie drinks is eating into the main Coke brand sales.
Cannibalization, but maybe the good kind.
I think so. They're successfully shifting consumers within their own portfolio to align with health trends. It actually de-risks the business long-term, moving away from full sugar reliance. Diet Coke was also up 2%, by the way.
Still, that overall 1% volume growth is pretty weak. You mentioned challenges.
Yeah.
Where did things really slow down?
Mostly in key emerging markets. Places like India had a tough quarter, early monsoon season hit consumption hard, some local issues too.
Okay.
China also didn't quite deliver the volume expected, and parts of Southeast Asia, the ASEAN region, saw some economic slowing. So those specific spots dragged down the global average.
Got it.
Yeah.
Which actually leads us nicely into strategy. The really big structural news this quarter was finishing that huge refranchising effort.
Yeah, this is a massive deal, the culmination of like a decade of work. They announced the last two big pieces.
Right, selling off bottling operations.
Exactly. Coca-Cola HBC is taking a controlling stake in the African bottler, CCBA, and they sold a big chunk, 40% of their Indian bottling business, to a local partner, Jubilant Bhartia Group.
So why does this matter for the listener? Why get rid of bottling plants?
Because it lets Coca-Cola, the corporation, focus entirely on what it does best, building brands, marketing, innovation, high-margin stuff.
Leave the capital-intensive bottling, the trucks, the logistics.
The specialized partners who are good at it. They found the whole system, Coke, plus its bottlers, grows faster this way. It frees up corporate management to focus on driving overall growth, not getting bogged down in operations.
And that innovation focus seems to be showing up elsewhere, too. Fuse tea, for instance.
Yeah, holding its global lead, growing retail value way faster than the industry average, something like 5 times faster.
And the sports drink strategy. Powerade and Body Armor together.
Gaining share, both value and volume. That dual brand approach seems to be working. And don't overlook dairy.
Right, you mentioned Fairlife earlier, still going strong in the U.S.
Absolutely, huge momentum. And they're replicating it. In Mexico, their Santa Clara brand is now the value share leader in that value-added dairy space, grew volume 13% this quarter.
13%. So they can take these specialized high-margin ideas and actually make them work in different markets.
That's the key. It proves the model is transferable, which is critical for future growth beyond just North America.
Okay, talking future technology, they mentioned AI aiming for impact to scale. What does that actually mean?
Well, think about their reach. Their system visits something like 30 million retail outlets every single week. Tiny corner stores, big supermarkets, everything.
30 million. Wow.
So they're putting AI into the systems their sales reps use when they visit these stores.
Okay, so the rep shows up with a tablet. What does the AI do?
It optimizes everything. It looks at that specific store's sales history, its inventory, the local neighborhood demographics, even local events, or the weather forecast. And it gives the rep tailored advice for the store owner, like, okay, based on everything, you should order 10 more cases of zero sugar this week, but maybe hold off on the Sprite and grab 4 cases of orange juice because there's a big soccer tournament nearby starting Friday.
So hyperlocal predictive ordering helps a retailer sell more, which means Coke sells more.
Exactly. It's a massive potential productivity lever, and they're looking at generative AI for marketing too.
Making ads cheaper and faster.
Basically, yeah. Lowering the costs and increasing the speed of creating commercials, digital ads, social media content allows for much more personalized messaging, potentially delivered way more efficiently than traditional big campaigns.
Right, we have to touch on risks. Analysts are definitely asking about the new weight loss drugs, the GLP-1s. What's the read there?
Yeah, it's a hot topic. The early data does suggest some real shifts in what people are drinking if they're on these medications.
Less sugary drinks.
Definitely less full sugar soft drinks. That's a clear trend. But interestingly, more diet soft drinks, more water and hydration products, more coffee, and a really significant jump in protein drinks.
Protein drinks. So back to Fairlife and that part of the portfolio.
Precisely. If someone switches from a regular Coke to, say, a high-margin Fairlife protein shake, well, that's actually potentially better for Coke's bottom line.
So it validates that long-term strategy shift towards dairy, protein, hydration, turns a potential negative into maybe even a net positive.
It seems that way, yes. Their portfolio is already positioned reasonably well to capture some of that shift. It's not purely a headwind.
Okay. Another challenge mentioned was new sugar tax in Mexico. That's a huge market for them.
It is. They acknowledge it's a risk they're watching closely, but they also seem pretty confident they can handle it.
Just raise prices.
They'll use that RGM playbook again, adjusting pack sizes, pricing tiers, maybe some local innovation. They managed through the last big Mexican sugar tax back in 2014 and learned from it. They expect some impact, but seem to think they can navigate it without major disruption.
Good to know. Let's look at financial health. Balance sheet's still strong. Cash flow looking good.
Very strong. All that operational efficiency is showing up in cash generation. They actually raised their free cash flow forecast for the year.
Oh, really?
Yeah, now expect at least $9.8 billion, which is up from $9.5 billion previously. And that's excluding a one-off payment related to the Fairlife acquisition.
Nice bump. And debt.
Debt levels are very comfortable. Net debt leverage is at 1.8 times EBITDA. Their target range is 2.0x to 2.5x, so they're well below that. Plenty of financial flexibility.
Okay, let's look ahead a bit. Thinking about 2026. After all these price increases lately, what's the expectation?
The word is normalization. They expect pricing growth to cool down, probably back into that sort of 2% to 3% range, assuming inflation keeps moderating globally.
Which means the focus has to shift, right?
Right. It shifts back towards driving more balanced growth. They'll need to get that volume number moving again. Targeting maybe 2% to 3% volume growth becomes the priority for 2026, rather than just relying on price.
And the other big shift for 2026, maybe some relief on the currency front.
That's the hope. After dealing with those nasty headwinds in 2025, the very early outlook for 2026 suggests it might flip to a slight tailwind.
Ooh, that'd be helpful.
A tailwind for both revenue and EPS. It would provide a nice little boost compared to this year.
Okay, so pulling this all together from our deep dive today, what's the main takeaway for you, the listener?
I think the key thing is how Coke is navigating this tricky global economy. They're doing it by really smartly segmenting consumers' premium for those who can afford it, value options for those under pressure. At the same time, they're aggressively shifting the portfolio to where growth is.
Yeah.
Zero sugar, dairy, specialized sports drinks. And underpinning it all are these big structural moves, finishing refranchising to focus the business, and now really leaning into AI for efficiency at scale.
It paints a picture of a company adapting pretty effectively. So here's a final thought. We saw how finishing the refranchising lets them focus more on brands and innovation. We see the big AI push for sales and marketing efficiency, remembering the culture of discontent. They talk about always looking for the next efficiency gain. What legacy cost or bottleneck do you think Coca-Cola targets next? Where does that relentless productivity drive focus now? Something to think about until our next deep dive.